Most people lose money in real estate, and it's not because they picked the wrong property. It's because they didn't understand how the deal was structured. You see this all the time. Folks get excited, big opportunity, big upside, beautiful brochure, strong IRR. The pitch sounds amazing. But behind the scenes, there's something buried. Some clause, some waterfall terms, some incentive misalignment. And that's the part they didn't catch, the part that cost them. Let me show you what I mean. Hi, I'm Ahmad. And look, real estate has been good to me, but not because I chased the right deals. It's because I learned how to structure them. I built Infinity 9 after selling my company, not because I wanted to be in real estate, but because I realized the real game isn't about properties, it's about capital. It's about how you design a deal to protect your downside and create asymmetry. And honestly, it took me losing money to understand that. I remember one of those first deals I walked away from, and it looked amazing. I mean, beautiful renderings, trophy location, sponsor with a great pitch deck. It projected 21% IRR, and everyone was talking about it. But when I opened the model and I actually started reading, something jumped out. The sponsor had built in a clause, and it basically said once the property was stabilized, meaning leased up, they could start taking distributions. Now think about that. They could start pulling profits before LPs even got their principal back. It's like being at a restaurant and the chef takes their tip the second the appetizer hits the table, before you even had the meal. That was the moment for me. I walked. 2 years later, interest rates spiked. The refi didn't come through, the deal got crushed. LPs lost money, the sponsor still walked away with a payday. And I remember thinking, it's never about the property, it's about the structure. So, what do we do differently at Infinity 9? We build a deal backward. We ask, what's the worst case scenario here? Where do we sit in the stack? Who gets paid first? Where's the sponsor's skin in the game? And when we rebuild the structure, because if you get the structure right, even if the property underperforms, you still protect your capital. Let me show you what I mean. There was a deal we ended up investing in, but only after we structured everything. It was a 228 unit multifamily in the southeast. Good submarket, stable workforce demand, and the sponsor was experienced. But the initial capital stack, it was 75% debt, 25% common equity. That's it. No preferred equity, no operating reserves, sponsor promoted, started at 8% IRR. I looked at it and thought, no way. Because if that goes sideways, even just a little bit, everyone was exposed. So we stepped in and said we'd come in with a preferred tranche, rebuilt the stack with a 70% senior loan, 10% pref, 20% common. We negotiated 10% current pay, 12% target IRR, and full return of capital before the sponsor drew a dime. We added a 500K operating reserve, put in cash traps. If the debt coverage ratio fell below 1.2x, distributions paused, period. And then we ran the downside, flat rent growth, construction delays, exit cap expansion. Even if the bottom quartile scenarios, our preferred equity was protected, we still made money. 18 months later, the sponsor refinanced early. We exited with a 12.7% IRR, no surprises, no drama. And that's what happens when you control the structure. Now, maybe you're not the one structuring the deal. Maybe you're coming in as an LP, a co-investor, a family office exploring US real estate. That's okay. You don't have to design the deal to protect yourself. You just have to ask the right questions. And honestly, most LPs don't. They wire money based on vibes or because they trust the sponsor. Let me give you 5 questions I always ask, no matter how good the deal looks. 1. Where do I sit in the capital stack? Am I ahead of the sponsor? Am I behind of the preferred tranche I didn't know? Picture the stack like a lifeboat. You want to know exactly when your seat gets picked up. 2. When does the sponsor get paid? Do they earn promote before I get my money back? Because if they do, that's a red flag. That's them tipping themselves before the meal ends. 3. what's the downside scenario, not the glossy version. I want to know and I want to see zero rent growth, cap rate expansion, construction delays, and I want to know where does my capital end up if that happens. 4, where is the sponsor's money and how is it treated? I once saw a sponsor say that it had $1 million in, but it was protected class senior to the LPs. That's not skin in the game. That's insurance. 5, what protections do I have as an LP? Can I get reporting? Can distributions pause? Can I step in if KPIs fall apart? Ask those 5. And you're not just capital, you're a partner. Think differently. You're allocating smarter, and you're going to build long-term wealth. I'll leave you with this. There's a quote I love from Howard Marks. You can't predict, you can prepare. And that's what this is all about. Structure is how you prepare. Prepare is what protects your family when the next cycle hits. Structure is the difference between surviving a deal and building a legacy. So here's what I want you to do. Pick one deal you've done or almost did, pull it up, ask the 5 questions. Where did you sit in the stack? When did the sponsor earn promote? What would have happened if the market shifted? That one review might change how you invest forever. And if you want a second pair of eyes, someone who's walked away from the flashy deck and seen what happens when the fine print hits real life, you know where to find me. Thanks for watching, and now go build something that lasts.